Hi, I'm Steve Decker with IPX1031 Exchange Services, and thank you for joining me to learn a little bit more about the identification rules and the timelines that you have to stick to anytime that you do a 1031 exchange. So let's start with the timelines. From the time you close the property that you're selling in the 1031 exchange, the IRS gives you 45 calendar days to identify property that you want to purchase, and they give you 180 calendar days to actually close on one or more of the identified properties. Now, it's important to take note that it is not 45 plus 180. These are overlapping time periods that both begin on the same day. So you only have a total of 180 days to complete your exchange from start to finish. It's also important to note that it is very infrequent where the IRS ever extends these time periods. In fact, there are really only two instances in which the IRS ever extends these timelines. And that is in the case of either military deployment or in the case of a federally declared disaster. Now, when I say federally declared disaster, typically that means earthquake, fire, flood, tornado, hurricane, active terrorism, or for a brief period of time back in 2020, pandemic. So once you are fit with those time periods, the IRS also says that you have to identify real estate. Now, typically you're going to identify your properties to us, your qualified intermediary. We try to make it pretty simple for you. We give you an identification form that we ask that you complete, sign, date, and return to us by no later than the end of your 45th day. Now, when you're identifying property, the IRS gives you three options or three different rules to choose from when you identify your properties. Typically, most of our customers will identify using what is called the three property rule. If you're just going to go out and buy one or maybe two properties, this is most likely the identification rule that you would use. The three property rule allows you to identify your top three choices: your plan A, your plan B, and your plan C. And thankfully, there's no cap on the value of those three properties. So you are restricted to only three properties or fewer, but they can be of any value that you want. Now, sometimes our customers want to significantly diversify. If that's you, if you want to sell one property and go to another area and buy 5, 6, 7, 8, 20 properties, you are welcome to do so through your 1031 exchange, but you would most likely need to identify under what the IRS refers to as the 200% rule. Now, under this 200% rule, what the IRS says is that you cannot identify properties that total more than 2 times the value of the property that you're selling. And this is the cumulative value. So for example, if I sold a property for $3 million, the IRS says you take the sales price of $3 million and you multiply that times 2. That means that I could identify up to $6 million worth of real estate, however that is comprised. It could be 25 properties, as long as the total value of all 25 of those properties does not add up to more than $6 million in value. Now, if you want to identify more than 200% of the value of the property that you sold, and you're going to identify more than 3 properties, you can default into what is called the 95% rule, or sometimes referred to as the 95% exception. This one is the most strict rule. It sounds great on paper, but when you do a deep dive, you find it is very infrequently used. And that is because under the 95% rule, the IRS says that you can identify as many properties as you want, which sounds great. They can be of any value that you want, which also sounds great, but you must actually close on at least 95% of the value of all of the properties that you identified. So if you only closed on 94% of the value, your entire exchange would be invalidated. I hope this information helps. If you need additional information, please feel free to give me a call or send me an email. Thank you for your time today.